In today's Tony Talks, we're having a conversation about C corporations versus S corporations. We're going to get into how each and each type is taxed. How do you know how it's taxed? Which one is better? The advantages and disadvantages. So let's just get right into it. Today, I wanted to talk about C corporations versus S corporations. Just day to day, I get a lot of questions and confusion about which one should I use, which one I am, which one is the best for me. And just to kind of get the ball rolling, as an attorney, is there any real difference asset protection wise to whether I'm using a C or a S corporation?
Yeah, so great question, Tony. And let's knock out that liability concern right out of the way. It doesn't matter how a corporation is taxed, whether it's a C or an S. You're going to be provided the same protections under state law, no matter how it is taxed, whether at the C corporation level or flow through entity-wise as an S corporation. Now, I'm sure you have some different opinions when it comes to the tax side of things, though, with you being a CPA, you being an enrolled agent, you see lots of different things when we have these conversations with our clients. So yeah, let's forget about the liability thing, because again, no difference between C or S. So really it just comes down to taxation. What's right for me?
Yeah, and I think part of the issue is C corporation, S corporation, they sound a lot alike, where really they are very dissimilar. The C corporation is typically its own entity, whereas the S corporation is owned by the shareholders. And that gets into the liability protection, where the corporation is its own self.
Exactly. So yeah, with either a C corporation or an S corporation, and of course we're talking about traditional C and S corporations, not LLCs taxed as C or S corporations, although you can have those, as you mentioned, we're talking about shareholders. So shareholders own, not control, but they own the corporation, and they're the ones that vote in the directors. And irrespective of the ownership interest, again, it's how the income is taxed, right? At the C corporation level, the C corp earns that income and it pays its own tax rate on the income that it produces. Whereas on an S corporation, as we all know, that the income, instead of being taxed at that corporate level, which happens to be pretty favorably taxed right now at 21%, instead, if you have an S corporation, instead of that income being taxed at that flat 21% rate, and again, that's federal, state rates very widely. And to that effect, when you have an S corporation, that same income, say you generate $100,000 in a C corporation, flat 21%. However, you generate $100,000 in an S corporation, the federal government might be taking a varying tax rate on how that income is taxed based on the individual classifications and tax brackets of the shareholders.
And I believe that is where some of the confusion comes in for a client, or maybe concern comes in for the taxpayer, is under an S corporation, it is a flow-through entity, so it does land on their personal tax return. And so then the concern then becomes, okay, well, it's representative of me personally now that it's on my personal tax return. And I think what would help to dispel that the mystery is perhaps if we kind of go through it, right? So every corporation starts out the same. You file it with whatever governing body, Secretary of State. You file your articles, you're a corporation, or perhaps you're a LLC. But then, after that, in order to be an S corporation, you actually have to make a special election with IRS to be treated as a subchapter S. File a form 2553. Without doing that, you remain a C corporation.
That's something I see way too often is people, because as Tony mentioned, you file a corporation, automatic C, and you have to elect that S status. So many people forget to make that election. Now, obviously, when we're working with our clients, we'll do that on behalf of our clients, but for a lot of people that are coming from outside with pre-existing entities, I see that mistake happen way too often, and it ends up being quite punitive in some cases.
Correct. And in our case, we're fortunate enough that the way we do things, that we're seeing every step of the way, whereas in other places I've worked as a CPA, I don't necessarily know what the attorney has done in establishing the entity or what I still need to do. And things as simple as like getting the EIN number, getting the S election filed if you want to become an S, If you're an LLC and want to file as a corporation, S corporation, getting the appropriate forms filed for that, because like you said, it doesn't happen automatically.
Yeah. Often forgot about. Now, why don't we talk a little bit about maybe some of the considerations that we like to account for when determining whether somebody should be in a C corporation or an S corporation. So let's pretend I'm just walking in off the street and I say, I'm starting an active business. I know I need a corporation, but hey, what's right for me, a C or an S?
Right. And I find that if you have an active business, so many times we see them filing their tax returns as sole proprietors, which has a very punitive self-employment tax that goes along with it if you're making money.
If you're making money.
If you're not making money,
no self-employment tax.
no
right?
self-employment tax. We may have a client who has substantial liability that they have no kind of protection at all. So the first thing we want to do is make sure they do have some kind of liability protection, whether it's simply an LLC. But for that operating type of business, we really like to see those in the S corporations.
So,
Well, I
so
would
you prefer
ask-
S, yeah?
I would ask a few questions first.
Yeah, what are
Because,
those questions?
With a C corporation, you are allowed to take some deductions and that you may not be in an S corporation. One of those that is just a blaring one is education as a startup expense.
As a startup expense, right?
Education as a
Because
startup expense.
under the Internal Revenue Code, we know we can still take deductions even on our personal returns, so long as that education expense is incurred
Well,
in
it's-
furtherance of our trade.
It's specific to continuing education, right? So
Yeah.
you can take continuing education as a deduction on your personal tax return, absolutely. But taking education as a startup expense, and sometimes just in the first year, because it is a new line or new line of business, new trade or business,
Yeah.
that's where you run into a little bit of trouble doing it on your personal tax return or in a flow-through entity type. Whereas a C corporation is actually allowed to have a workforce in place. As a C corporation, I'm actually allowed to, let's just say I'm going to be opening a grocery store or a convenience store, and I need to train my workforce. I hire them before I open my doors. And I train them. I'm allowed to do that before I open my doors in a C corporation. So you're allowed to have what they call a workforce in place. Therefore, you're allowed to deduct any education training as a startup expense on a C corporation, where you can't do so in an S corporation.
And so the key point there is in learning that new practice, that new trade or business. Whereas if you're in a flow through, you're saying you can't otherwise take an education
Correct.
deduction to learn something new.
Correct.
Yeah.
So, one of the questions that I like to ask the clients if they've not incorporated or they're not already currently working inside of a business entity or a business structure is, okay, what kind of training and what kind of startup expenses have you already incurred to make sure that maybe we want to start out as a C corporation when we're running an active business or perhaps having active income coming in, because we can make an S election in maybe the second or third tax year. What do you think about that, Jeff?
Well, you have to be careful with that because you don't want to have a couple years of C corporation losses and then change to an S corporation because those losses get trapped with a
Right.
C corporation.
Right.
And you can't get them out until you go back to being a C corporation.
So then that'll be a matter of tax planning, right? So
Absolutely.
every year when we're looking at it, if we've gotten to a point where we've exhausted those education expenses by, creating income within that corporation and eating up those deductions, if you will, maybe in the year where they've actually had positive cash flow, positive income, maybe now it's time to talk about converting that to an S corporation and making that subchapter S election.
So a perfect example of what you're talking about is say I am a retail store that I'm making about $50,000 a year. If we can put enough other expenses such as the education or the continuing education, there's some other expenses we can talk about, corporate meetings.
How about an accountable plan?
Accountable plans that reimburse
Yeah.
you for certain expenses. If we can take those expenses and also add them, because those expenses are mostly not deductible to the individual, but they can be reimbursed by the corporation if they are for the corporation's business. So if we can reduce that income to the corporation through those additional expenses, while at the same time reducing the individual's income, that's a benefit for both. What's made that line even more blurry was the Tax Cuts and Job Act, which reduced, as you said, the corporate rate from 35% down to 21%. So, as you said, at that point, tax planning becomes really important.
Yeah, absolutely.
Well, yeah, through C corporations back into the mix as being a viable alternative to the flow through taxation, because of the reduction in that overall tax rate. And you mentioned the Tax Cut and Jobs Act. One thing we haven't even talked about yet is the 199A deduction that's applicable to all flow through entities and therefore S corporations as well.
So that has to be a consideration when you're looking at whether you should be a C versus an S corporation.
It's got to be, yeah.
100%. Now, I look at C corporations and S corporations as both like excellent tax planning tools to have in your toolbox. C corporation, because it is just a separate taxpayer. So that's just the best tool you can have in your toolbox if you're looking at any kind of income splitting, to get certain amounts of income or certain types of income off of your personal tax return, moving it into the C corporation box. And maybe it is better, to your point, Jeff, if we are moving it up there and there is a positive cash flow, if we are taxing it at the 21% based on what your own personal tax rate is. But then the S corporation has its own benefits, right? The S corporation can help you to avoid the self-employment tax while still being a flow-through entity, so you have the ability to take distributions from the S corporation. So sometimes the S corporation, as an alternative, of course, to a sole proprietorship or maybe just an LLC taxed as disregarded or a partnership, we're not staring down the barrel of self-employment tax when we're using an S corporation. Likewise, it is easier, can be easier, let's say, to get money out of the S corporation than it is the C corporation. Although, with an S corporation,
Always a but, right?
Although, with an S corporation, you may be required to pay yourself a reasonable salary depending on your specific set of facts and circumstances.
And we get that question so many times about salaries. And in general, if you're not profitable, you certainly don't want to be paying yourself a salary. But if you are profitable and you're taking money out of your company, the salaries is a consideration. It's not really going to change how much goes from your S corporation onto your personal return. It just means now there's going to be some payroll taxes involved and a W-2 involved.
And that's part of the planning discussion is, a lot of people, a lot of our clients and investors in general, they're not just doing one thing, right? And, maybe part of the conversation is, hey, I want to make myself look more fundable. So therefore, I want a W-2 salary. So before I do anything else, I'm going to take that W-2 salary because I've got these ancillary goals that do require me to show certain types of income on my personal return.
Well, I have another question for you, Aaron. Now, you mentioned a good point. A lot of people have multiple activities going on, multiple lines of business, and perhaps, it's not all the same thing. So let's just say we have someone who has 3 different types of active revenue streams coming in. And so then we go, okay, SSS, we're going to do 3 S corporations. Now we have 3 1120S tax returns to do, which is, of course, increasing the client's overhead and their costs in maintaining these entities. So one solution is to perhaps do some LLCs as disregarded entities to one S corporation, or maybe doing a Q sub. What would be your opinion on having these different types of activities flowing through to the same S corporation?
Oh, from an administrative standpoint, I'm totally behind that. Again, whatever's going to make it less burdensome, less cumbersome to our clients, all the while still being able to achieve the liability protection that's otherwise afforded. If you were to do that same activity through an S corp, you're still going to get that liability protection through an LLC, except now we're just going to consolidate it and I'll put it on a single
Very
return.
good.
Yeah.
Because from a tax perspective, I believe that it does serve the client to have as little tax returns as possible. Again, it's a cost issue, time issue, paperwork issue for the client, or concern, not so much issue, concern. And I think just part of the Anderson values, we want to make sure we do the best that we can to make things as efficient and as cost effective as possible for the client. So from the tax perspective, using a sort of subsidiary method, if you will, of having your different boxes, your LLC, so you're getting that separation of activity, separation of assets, but then it's flowing through to one S corporation, therefore creating one tax return.
Oh, and all the while, to
Even
that
one
effect-
set of books.
Well, I mean, you could still keep separate books for each LLC, but then, yeah, it's all going to be on one consolidated return, if
Yep.
you will. Yeah.
But we
yeah.
can do one set of books, right, Jeff? We can do one set of books. We just class out each of the different activities or
Yeah.
each of the different businesses.
That comes back into the asset protection part of it. That why do I need to separate? Well, for one thing, you don't want all your eggs in one basket.
Right.
So,
And then we have to look at those structures, the subsidiary types of structures, where do we have things at risk that may put the entire chain at risk?
yeah, so I mean, and that's why I'm a big fan of maintaining separate books and records for that reason. So that way, the client, whoever's in charge of that particular overall endeavor, they're not tempted to, hey, this is all one tax return, so I'm just going to take money from this one LLC account and put it over here.
No.
That's the way that you're shooting yourself in the foot.
Absolutely.
And chipping away slowly at your liability protections. Because remember, at the end of the day, we do all this, all the keeping separate books and records, maintaining separate bank accounts, all that. We do that so that in the event we are sued, right, we can still go before a court. We can go before a judge and a jury and say, Your Honor, jury, I have treated each one of these endeavors as separate entities, so therefore you should too. Now, again, by commingling, by not treating them as separate endeavors at that LLC level, even though they may all be disregarded to a single S corp, by not treating them separately, then you're giving rise for a plaintiff to be able to make the claim that it's one common enterprise, and therefore there should be no distinction, no separateness between those
Right.
subsidiary LLCs. So for that reason, separate books and records is the way to go. Maybe from a tax perspective, you could get by. From a liability perspective, though, you certainly want to make sure to keep the separateness of each one of those endeavors. Yeah.
Yeah, I agree with that. But it's good to hear it from an attorney's mouth.
Right. So, but another piece of the puzzle, if you will, when somebody walks into my office and says, should I be an S or should I be a C? It's what else do you have going on, right? Because if you're a high income earner and say you've got, you're whether you're a doctor or an architect or another attorney, these are the typical types of clients that have these advanced dilemmas, if you will, where they're making too much money. It's a good problem to have.
Exactly.
But yeah, they come in, they sit down, they say, you know what, I don't need all $500,000 of my salary that I'm currently making as a doctor, right? I don't need all that to flow down onto my personal return. I'm taxed as an S corp right now, hypothetically. I'm taxed as an S corp, so all $500,000 is hitting my return. I don't need that, right? Because those dollars, the individual tax bracket to get up into the highest 37% tax bracket right now is just over 500,000, I think. And so let's say they're making 600,000. So those dollars that are over that threshold are being taxed at 37% at the federal level. And then, hey, if you're in a high tax state like say California, New York, Massachusetts, those dollars that you're earning are you couple in the state tax rate, close to 50% on those dollars, they're being taxed at that rate,
Right.
when those dollars are earned over that threshold.
If you're making over $1 million in California, I just want to say I'm sorry.
Right?
I
I want to say congratulations.
Who thought you'd be uttering those words, right? But yeah, so for that reason, that would be, for me, one thing that I would weigh when saying, okay, maybe it's now time to convert from an S over to a C, and you can still pay yourself a reasonable wage from that. What are your thoughts on that?
Well, it's funny because the TCJA actually did a few things. In the past, you would never put your professional companies into a corporation. You could, but they were considered professional service corporations. And any income left in the company at the end of the year was taxed at the highest individual rate. So it was a really punitive tax. The TCJA, Tax Cuts and Jobs Act, eliminated that. So we can now choose what kind of entity we want to be in. We've taken some that were S corporations previously and now made them back into C corporations. So it's another thing that's kind of blurred the line, especially with the professional organizations that are very profitable. They're not going to get that 199A deduction, the qualified business income deduction for pass-throughs, just because the way that code works. They're going to be making too much money.
But a lot of the people, as doctors specifically, that come in and who haven't gotten relevant or pertinent tax advice, because whoever they went to, that tax professional simply said, "Oh, your personal services S corp." Right?
Well, it's been kind of beaten into accountants, CPAs, and so forth that corporations are bad, be an S corporation, because of the double taxation and the higher tax rate. That's no longer the case, and unfortunately, a lot of the accountants and CPAs, especially ones that have been practicing a long time, haven't caught on to that. The better ones have.
Well, the double taxation for me is, number one, it could be that you're not facing double taxation depending on how low your tax bracket may be.
Now, just to clarify, double taxation, when we talk about double taxation, we're referring to the fact in a C corporation, you get taxed once at the corporate level, and then if you pull it out as a dividend, then you're taking a second tax hit, if you will, when you report that on your personal return.
So my answer to that is, don't take it out as a dividend distribution if your income is that will be over the 0% capital gains tax rate, right? So just don't take it out as a dividend distribution. If you can take money out of the C corporation as a salary,
Correct.
and the salary is deductible to the C corporation, thus no double taxation. Now you're going to pay everything else that comes along with that. You're going to pay the individual tax on that payroll. You're going to pay the payroll tax, 50% of it on the corporate level, and you're going to be responsible for the other half. But my response to that, when people are asking me about, hey, why are you recommending a C corporation? I don't want to be hit with double taxation. Well, you won't, as long as you're doing the appropriate tax planning.
My comment whenever I hear, because I'm a big fan of C corporations. I have a C corporation that I use for my real estate, and I have an S corporation that I use for my management, my consulting business.
You also have an I Heart C Corporations poster in your office.
I mean, you know what? I didn't know you saw that, but yes, I'm very proud of it. But yeah, in any case, when people you talk about that buzzword, right, double taxation, when I recommend C corporations, oh no, double taxation. Right? My comment is, if you're actually faced with double taxation in a C corp, that means you are making so much money in your C corp that you can't otherwise find a way to expense it out. Okay, it's, in my opinion, it's a good problem to have,
Right.
because we know under the corporate tax code, corporations are offered the most amount of deductions over any other entity type, over the individual tax code, over the partnership tax code. That's where all the benefits are in the tax code, are under corporations.
Correct.
And so, especially in light of the Tax Cut and Jobs Act, as well as everything else that was in the tax code previous to the Tax Cut and Jobs Act, I mean, we have a lot to work with to reduce the amount of taxable income that we earn in a corporation, regardless if it's an S or a C.
And you may not have to make a choice. You can use a C corporation in conjunction with an S corporation. You can have both.
Right.
And you can have a services agreement between the two.
What do you think I do?
And you can just have a services agreement between the two, where your C corporation may be responsible for, the accounting, working with Anderson, right?
Right.
Getting the counts, not counseling, the accounting and tax
Accounting's
planning.
kind of counseling.
Right. And you just have the C corporation there to serve, a separate set of purposes. So your S corporation is going to be there to be your workhorse, right? Whatever it is you actually do. If you're flipping, you have a flower shop, whatever it is your active income, your active line of business would be in the S corporation. But then you have your C corporation on the other side who's handling a separate set of business. So in that case, you can have your S corporation pay your C corporation a fee for those services that it's providing. You just want to make sure you have that services agreement in place between the two. So I quite like the C corporation for that purpose. So a lot of the time when I have clients who have, say, multiple rental properties, and they're looking for a way to maybe mitigate some of the tax there, say, okay, well, let's have your C corporation handle your LLC that owns the property is going to be taking care of the property. We're not saying that the corporation is a property manager, although it could be.
It could be, yeah.
But the C corporation is going to handle specific set of services, while the LLC is handling everything specific to the real estate, right?
Yeah, the C corporation's the entity manager, not necessarily the property manager, but
Right.
just takes care of everything on behalf of that LLC,
Right.
for which it derives a fee.
So
Yeah.
then you're paying a management fee up to the C corporation. And the C corporation is either going to be taxed at the 21%, or you're going to have those expenses from that C corporation, such as the education we talked about earlier,
Education, accountable plan,
medical reimbursement,
medical care
perhaps.
reimbursements. That's a big one because that one isn't applicable to S corporations.
That is
correct?
not applicable to S corporations, but what is applicable to S corporations is that you can deduct your insurance premiums, your medical insurance premiums on the S corporation. You do have to account for it as payroll. So you do have to account for it on your W-2 that you're issuing, but on the W-2, on the 1040, when you report the W-2 income, you're also going to be able to take an adjustment, adjust the income for those insurance premiums.
And that's one that's actually difficult to explain to clients because you tell them how it works and how it's going to go on their W-2, and they usually respond with, "Wait, what?"
Right.
And you have to explain to them that, no, you actually finally get the deduction on your 1040 on the front page, well, what used to be the front page.
Well, it's a wash on the
It's a wash.
1040. It's
It's
the
a wash in the
deduction.
1120, or in the S corporation return, and you actually get the deduction on the 1040 for you personally. So normally you would increase your salaries by, say, if you had $20,000 in insurance, but you would also take a deduction for $20,000 in insurance. So there's where the wash is. And then, like you said, if you don't report it on your W-2, you can't take that deduction. Then
True.
it goes on Schedule A as an itemized deduction, and good luck with taking that deduction.
Right. Especially with that standard deduction having been doubled.
Right. Yeah. Exactly. Yeah.
Now, one thing, when talking about should I go S corporation, C corporation, we've said a lot that it depends on your situation. There's a few situations where you definitely don't want to put it in a C corporation. There is a tax called the personal holding company tax, which if you have more than 60% of your income from investment type items, there's an additional 20% tax. And by investment type income, they're talking interest, dividends, rents,
Royalty.
and royalties. So you don't want a lot of that type of income in your corporation. If you're putting all your rental properties in corporations and you're profitable, it may cost you.
And that also has a tax effect on the Section 1244 small business stock in the corporation. So basically the rule is that if I dissolve my C corporation, I can actually take the losses on my personal tax return up to 100 married filing jointly, 50 single, right? Okay.
As an ordinary loss. Right?
As an ordinary
Yeah.
loss is the distinction, right? Absolutely. However, if more than 50% of the income of the C corporation is portfolio income, so the types of income you were talking about, you are not going to qualify for that Section 1244 small business stock loss.
Oh, see, important consideration. I never even factored that in.
Yep,
Yeah.
yep. And that's what we have to look at as well when we're looking at, okay, are we going to be a traditional C corporation, or are we going to be an LLC taxed as a C corporation? Kind of rule of thumb for me when I'm looking at it is, if you're going to be in an active business, right, and you're flipping, let's just say, the intent is to, create considerable income at one time from that project and so on and so forth. I'm going to probably say an LLC taxed as a C corporation is the way you want to go. Alternatively, if you're a management company and you're relying perhaps heavily on another business having a profit so you can get a percentage of it, you might go with a true C corporation so that you can make that small business stock election and be able to take that loss, because you're depending on the success of other business endeavors if your management fee is going to be a percentage of the profit.
Makes
Right.
sense.
Because that LLC doesn't issue stock. So they're not eligible for that 1244 deduction.
Great point. Yes.
And so that's why, it's a fail-safe, if you will. That's why, by default, many of our clients are structured in a traditional C Corp because a lot of them do, in addition to flipping activities, they will use it as a management entity as well.
Right.
So, the traditional C Corp tends to fit the bill right there. Yeah.
Yeah. So it's not necessarily saying you're going into this with the intent to be a loss leader, but you know that there's the risk of that when your business model as a management company is designed to get a % of profit from a startup.
Yeah. Inherently a little risky. So yeah, you do want to have the ability to capture that loss in the event you do have to dissolve it
And-
as an ordinary loss that could offset income earned from other sources in the year in which you dissolve that entity. Yeah.
And that's the spirit in which 1244 was written. It was written in order to give people a little bit of a safety net, so they would have less reservation about going out there, being an entrepreneur, starting a business, employing people, stimulating the economy. IRS said, okay, well not IRS, but he said, here you go. We'll give you this little safety net. If you go out there and you try, we'll let you go ahead and take the loss on your personal tax return.
So
Up to a certain limit, right?
Yeah.
So we talked about the advantages and disadvantages, and I think the conclusion is it really, really depends on your situation.
You sound
very
like me
much so
now.
does.
I'm the attorney. I'm the one that says it depends, not you.
And that kind of concerns me because I know how many people go out to these online websites to get their documents, their organizational
yeah.
papers, when they may not have a complete picture.
Self-help.
Yes.
Yeah.
They're not getting advice from anyone, whether it's us or their CPA or an attorney or something. They're going at it kind of blindly based on something they may have read in a blog.
YouTube University,
Yes.
right?
YouTube University, I love it.
They're
Yeah.
issuing law degrees now. You didn't know?
I heard that.
But yeah, I mean, to sum that up, that's exactly why you need to work with somebody who knows what they're doing. If you don't, the repercussions could be tremendous in that instance.
I also think that, sort of in conclusion, there are benefits to both. And there are also pitfalls to both if used inappropriately, or like you were talking about with commingling, if you're going to use the kind of structured way of doing things and having flow through entities to other entities and things like that. So there's a pro column and a con column
As with everything.
to both of these. So to both of your points, my best advice is to get professional advice.
There you go.
Well, thank you for that. Thank you, Jeff. If anything that was said today piques your interest, you want some more information, want to sit down, speak with somebody about your particular scenario, please, by all means, pick up the phone, give us a call, go visit our website. It's up on the screen in front of you right now. And on behalf of everybody, we look forward to working with y'all in the future, and best of luck in your investing.